Internal rate of return, or IRR. This is the method that attempts to answer the question for under capital budgeting, exactly what percent does the project actually earn in form of a return. A simple example is if you invest $100, you get back $100 plus a 10% return on, or a $10 return on top of that. So you get back $110. That's an internal rate of return of 10%. It's the single rate of return that basically tells you how the investment benefited you as an organization. Usually, if our company is targeting a certain return, let's say our company says we've got to earn 15%. If the IRR is greater than that, then we would say that the investment is acceptable. So this would be like comparing it to the cost of capital that's used under a net present value project. If your company's cost of capital is 12% and the IRR is 13%, then it's an acceptable project. So for that reason, we would say that there is a relationship between internal rate of return and net present value. Basically, if you have a net present value that's higher than 0 for a specific project, then you know that the IRR is going to be higher, at least equal to or higher than the cost of capital or the required rate of return for the project. And then the reverse is true as well. If you have a negative net present value, then you know that the internal rate of return is going to be less than what the company was targeting. To calculate internal rate of return, basically there is a trial and error methodology that provides the framework for how we do this. The trial and error method itself is very lengthy and time consuming. Many textbooks today do not even cover it. It used to be very prevalent and today has virtually faded because of the intervention of technology, which has been able to help us in solving these particular types of problems. So we usually either use financial calculators or spreadsheets today to figure out the IRR. With calculators, what you're going to use is the cash flow function of the calculator. Be very careful that you've cleared everything out and that you understand, based on the user manual of your calculator, the correct methodology for putting in the cash flows and solving for IRR. In Excel, we're going to use something called the IRR function. So let's go ahead and give that a try here. This problem has cash flows for an investment of $100,000, and then we see the cash flows that are returned in years 1 through 5. You'll notice that we've previously calculated a net present value and that the company is targeting a 12% cost of capital. In other words, hoping that this project has at least a 12% return. Although it is not necessary to calculate NPV prior to doing internal rate of return, since it's already here, let's take a look at it. This project has a positive net present value. Since it has a positive net present value, we know before we calculate the internal rate of return that the IRR is going to be higher than the targeted 12% cost of capital. And here's how we calculate IRR. We're going to use the IRR function, and it's very simple. It just asks us, where are the cash flows? And in this case, we will include the cash flow in year 0, which was the investment amount of $100,000. So we'll simply outline the cash flows here and make sure that they are in order from year 0, the investment period, all the way through year 1 through 5. And when we hit enter, it tells us that the actual return that's earned on this particular investment is 24.05%. And that's what we call the internal rate of return. You do notice that that is higher than the cost of capital, which was being targeted up here, and that we knew that that was going to be the case because there was a positive net present value, meaning the project has a return higher than 12%. IRR tells us exactly what that percent return was. Here's a sample problem for you to work through. Take a few moments and press pause if you need to, and then enter an investment amount of $5,000. Remember, that will go in as a negative number either in your your calculator or the cash flow streams that are showing in your spreadsheet, and then solve using either the IRR function in a spreadsheet or your calculator's cash flow function and come up with an internal rate of return. The answer is here on the bottom of the screen. Here is another example for you to try. This particular example has a $100,000 investment. Make sure that that is a negative number when you place it in your cash flows in year 0. And then cash flows for years 1 through 5 are as they are outlined on the screen. And the answer is here for you as well. One of the nice things about the internal rate of return method is that it is fairly simple to explain and fairly simple for people to understand. If you say to your boss, this project has a 20% return, most of the time he'll understand what that means. It's less complicated to explain than net present value analysis to someone who does not understand NPV. And it generally leads to the same decision as net present value, so it's a fairly sound methodology to use. There are some inconsistencies or some problems with internal rate of return. One of the things that happens sometimes is that in the calculation of IRR, it's sometimes not mathematically possible to come up with the exact correct answer. There have been cases, many cases, where in fact you can come up with 2 correct answers, and it's difficult to discern which one is closest to the truth. And there are just some quirks with the mathematics that cause this. There's another thing with IRR that some people do not like, and that is the assumption that future cash flows are reinvested at the internal rate of return and will continue to earn that rate. So for example, if you have a project that has a 75% IRR, you assume that the cash flow you get in year 1 is being reinvested and earning that same 75% all the way through the life of the project. The net present value method does not make that assumption. It assumes that future cash flows are reinvested at the company's cost of capital, and that's considered to be a more conservative viewpoint. So a lot of people consider IRR to be a little bit more aggressive and therefore maybe not quite as safe a method, and there are some quirks or problems with the math occasionally. And so for those reasons, we consider IRR to be maybe not quite as sound as a net present value methodology, although generally speaking, most of the time you're going to reach the same decision regardless of which of these 2 methods we use.